Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of the Qs. That's the QQQ. It's the Invesco Trust that basically tracks the NASDAQ market. First off, Happy New Year. This is the first broadcast of the brand new year, and I'm very happy to be able to continue on into 2022 to deliver you these reports. Now, last week, I said we would move up and come down, and I left my targets in place. I did not move those. I said we would most likely move to the lower levels with my target to the downside of 391.14. On Wednesday, we literally blew through that target and continued lower. Today is a very interesting candle because while I erase these, you'll see that down below, the momentum indicators are still going lower, even though the stochastics is oversold. We have a slightly higher volume today on the Qs with a bearish engulfing candle. Now, this bearish engulfing candle is showing up right at a key support level right here. So if on Monday or Tuesday we break out below that support level, then the support level reverses its role and turns to resistance. So that's number one. Before I draw my forecast lines, let me just show you this. On the weekly chart, this is what really got my attention today. On the weekly chart, the NASDAQ closed here below that 20-week moving average. And that's the first time that's happened since the COVID crash in 2020. So that is a significant signal right there. With a fairly dramatic increase in volume this week, we had more than twice the volume from last week, and the oscillators down below are showing momentum increasing to the downside. So this is actually going to be a tough forecast for me because we have a conflict in some of the other markets that I'll get to here in a moment. But again, I think we're going to go a little bit lower early on in the week, and then we will have to see what happens with the volume. I'm playing a conservative downside target of 376.02 for our option traders. We've rolled down our short options on our put spreads to capture more profit, and that's working out absolutely perfectly for them. If you're not trading options yet, or at least like to learn more about how to trade options, just go to marketrebellion.com and plug into one of my sessions there. So again, that's my downside target for the Qs, 376.02. Now I'm going to hop right to IWM, which is the Russell 2000 ETF. And again, my line last week was that we would go lower with my target at 219.14. We hit that one and then blew right through that one as well. Going to erase these lines now that the targets are hit and show you what's going on here. Now, this is the conflict that I was mentioning here a little while ago. We have a bearish engulfing candle right there, but we have a lower volume indication, which tells us that the sell side momentum is not as strong as what we saw on the Qs. Now, I'm going with the candle pattern first because 80% of the time when we see a bearish engulfing candle, like we saw back here, see that? Bearish engulfing candle resulted in lower prices. I think we could see the same thing, mainly because today's high failed to stay over that 20-period moving average. So the close for today is still pointing me in a downward direction. I'm not going too far down because we have a support level down here. Downside target of 213.83. 213.83 for IWM. Now I'm going to hop right to the VIX because the VIX is a leading indicator for us. And here's another conflict. The VIX is starting to turn here on the CCI. Short term, I think the VIX could drop and then move higher from there. However, my long-term target, which I've been keeping in place, that ends on January 23rd, is that ultimately I think the VIX is going to go up to test that resistance and also fill this gap. Again, I put a guarantee that gap will fill. And at that point, we'll have to see whether or not the VIX pulls back from this resistance up here. But for the next week, I think we're going to drop just a little bit, which could rally the spiders early on next week. And then we see the sell-off as the VIX rallies. Remember, for the most part, they're inversely related. So I'm putting that target right there, just the way it is. I'll keep that in place for next week and immediately hop to SPY, which is the S&P 500 ETF. Downside target has not been hit yet, although I'm going to put a horizontal line right there and show you what I think we're going to see for next week. I'm going to erase that, but I'm keeping that target in place with that horizontal line, right? I'm going to erase this, clean up the chart just a little bit. You can see that we have an oscillator down here called the stochastics that has a super wide divergence between the K and the D. Now, when you see that, that generally means we're getting ready for a snapback, right? So I do think that we could see a snapback on the S&P to the 20-period moving average, at which time I think we're going to move right back down to fill the gap and possibly go lower, because we have a gap all the way down here that's still unfilled. It's an open gap. So again, we have to watch out. Early on, think we could rally up, test that moving average as a roll reversal resistance, and then take a ride a little bit lower. Now, if you're long anything at this particular point, the best advice I can give you is to keep your stops in place or protect your positions or hedge your positions against a downside move. This is a critical point in time for the markets overall. We've been hitting the numbers for going on 8 weeks, precisely 8 weeks. We're hitting our targets. And this is the only one that has not hit yet. It will, I believe, next week. But that will, I believe, ultimately score on the positive for our target forecasts. And again, keeping your stops in place is not a bad idea. Now, the diamonds, watch what happened here this week. I got a little bit of a congested chart because last week what I did is I threw my Fibonacci retracements here. I said we would start to pull back. This is one also that I'm keeping that target in place because the Fibonacci is right there at the 38.2 pullback point. This target I think will hit, see a little bit of a bounce, and then the lower target. Let me clear that up for you so you can see what this will look like on a cleaner chart. All right, so I do think that we're still going to go lower to hit that Fibonacci retracement, maybe bounce a little bit. I'm doing an ABCD pattern here for you, folks. This is a complex forecast, which I guarantee you no one's going to do that. Basically, an ABCD pattern is a common pattern where we start at a high here. Let's go to A. It pulls back to B. We generally get a bounce to C, and then we get another drop to D, at which time we get a lot of buyers at the D where it generally pivots. Google the images and look up ABCD trading patterns. Something I teach in my technical analysis course. It's not rocket science. It's a general pattern. We see it over and over again. But that's the zigzag that I'm going to leave in place for you. Now let's give you the forecast on this and let's see how far we get on this one for accuracy. All right, downside price target first next week. It's going to be 359.47. 359.47. Then I think we're going to see the bounce up to 361.01, which will be the moving average. And then by the end of this month, very much in line with what I had the forecast for the VIX, at the end of this month, right around January 22nd, I'm putting a downside target of 355.18. By the way, this is the first time I've done an ABCD forecast on the weekly market report. I do it quite often during our Oracle hour on Wednesday nights, but I have never done that on a weekly market forecast, and I'm going to leave that up there until we hit those numbers. All right, so that's for the diamonds. Now, I have not been giving a forecast on Ethereum. We have a position in this. I didn't want to have a conflict with my positions and our forecast. However, we've had a lot of people asking about this. We have a long position in ETHE. And as you can see here, we have a move right to that key support level, which happens to be a roll reversal. See, back here it was resistance. We broke out over resistance, hit support again. We're at support now. And if you look down below, you see that the CCI especially, let me magnify that for you right there. CCI is starting to hinge, right? A hinge is when we get a change in the direction of that CCI, and we're seeing it on a down day. So that's a positive divergence. So for the Ethereum market, I do believe We're going to see a rally. I'll drop it right there. The moving average is continuing to drop, but I think the upside target will be reached on Ethereum at 3143 for Ethereum as our price target. Now, I want to leave you with this. On my Twitter page, I'd like to invite you to join us there if you're not already. We have 37,000 followers there. I posted this on January 6th, and I want to report on this and more or less elaborate. This is the highest level of margin debt that we've had in decades, if not the highest level of margin debt. Now, that turns out to be bearish for the markets as the markets continue to turn lower. Why? Well, if you've ever been faced with having to meet a margin call, you'll know that the broker only gives you two choices. Bring in more money to finance your bad position, or sell out of the bad position and move to cash. Most people opt choice number two, which is to sell out of the position. So if we get a large majority of investors or even traders that are getting hit with margin, I'm just pulling this one out of the hat as an example. Let's say Apple, okay? Apple is closing below the moving average. These are my forecasts, by the way, from my weekly sessions I do with our members. But Apple today hit that price target that I set last week at 171.19. Now that it's closing below the 20-period moving average, you see how the moving average is starting to turn lower. Anyone who's caught in a margin call right now is most likely going to sell out of that Apple position to alleviate the pressure, release themselves from the margin call, get the broker off their backs. And what does that do? It actually continues to put selling pressure on that stock. Again, I'm just pulling that one out as an example because it's one of Wall Street's darling positions that are held by many investors. All right, so you have to be careful with that because the margin requirements, the margin selling could push us lower a lot faster than you may imagine. So again, Happy New Year. Thank you so much for following us. Looking forward to a very exciting 2022, very profitable new year. And with that, have a great weekend. We'll talk to you next week. So long.